Welcome back to Be Great Economics. This is Nate. The stock market has been an absolute tirade recently, and there's a lot of chaos in the market. So, what should we be talking about? We should be talking about hedging. We're going to talk about the total trends that you see in the stock market and how overall they generally trend up. But we see that stock market psychology or market cycle psychology shows us that we generally have long uptrend periods where we can't tell, is this the top? Is this the top? Is this the top? Like, we don't know when it's finally going to capitulate. We don't know when the risk is going to get too high. We just get a feeling. And the problem with these feelings is that they're based off of emotion. They're based off of some pretense and reference for value, but we don't know how long that can go on. So what we want to do is we want to protect ourselves against the downside for short periods of time when we think that the chaos is a little too high, where the risk is a little too high, and we want to control our risk to the downside. So this can be done pretty simply, and we'll talk about hedging. Originally, like most weird words in the English language, it's from some British term from a long time ago. A hedge is literally referring to both a hedgerow of plants as well as fences. It's meant to keep in or control the area. It's a hedge. It's meant to reduce the risk of the sheep running away, right? So the concept of hedging is to reduce your risk on one side of the equation. But remember, I said this before, risk cannot be removed. It can only be transferred. So you can't get rid of the risk. You can just change what type of risk you're getting, right? And so we're going to go over the most basic hedging strategies, starting from the simplest one and getting into more advanced as we go. And there's not going to get any further than what the newer investor who's been investing for maybe 3 years is going to need to know how to do. So one form of hedging that we can control is we can go to cash. Now, cash can be a good hedge in that it gives you an opportunity to buy later. But there's two things that you're paying for holding cash. One, inflation. The longer you hold the cash, the less it will be worth long term. But you're betting that the stock will go down faster than the dollar will, so you'll be able to buy more of the stock. And since historically we get a chop, and in the S&P 500, you have a 99% chance of the price, once it goes to a new price, coming back to a previous price. So you're guaranteed that if you go to a new all-time high, you will go back down to the previous price before that. Almost guaranteed, 99%. So what else does it cost? It's opportunity cost. If it gets away from me, my cash is not in something that's making me money. It's in something that's losing me value, losing my purchasing power. So this can be opportunity cost. Most of us don't want to have a very large cash position. We do want a cash position, and depending on how concerned you are about the short-term actions, you may want a larger cash position. This is probably the best option for people who are new to investing, is to mostly work on your savings. And then this way, when an opportunity does come along, you can really go heavy in it when the stock market is a little too volatile, a little too high risk. And so another thing we can look at is rebalancing. This is basically the same concept as going into cash, except that you're going into other assets that aren't as high risk. So if the risk is specific, like it's to the stock market, but it's not going to be the bond market, and I want to increase my opportunity in the bonds, then you might increase your bonds. If the risk is to a specific stock, let's say it's Tesla, it's really, really high, but then I can buy a value stock like Coca-Cola. Coca-Cola might come down too, but it's not going to go down 50 or 60%, it's going to go down 20%. And so I'm getting less risk there, but I'm also receiving a dividend, so I can hold it for longer periods of time while I wait. So you can rebalance or reweight on a quarterly, monthly, annual basis, or on event basis. But you can also reallocate to another form of monetary assets like gold. Something that responds differently, so you don't have necessarily the same inflation decay, but you have a different volatility risk. And so since it's a different kind of risk, it's just a diversification. And we can rebalance to other solid assets that are going to protect us and get that weight into something that we actually feel makes more sense. If when you're scared, you think that, man, I shouldn't be invested this much into this, that should tell you that you're overinvested into it, right? Because if you're scared here, think about how scared you'd be when it actually goes down. And so that's why it's good to talk about hedging when we're seeing chaos in the market, because we should generally prepare for this and think long term that this little chaos doesn't matter too much, but I do want to maximize my opportunity to both roll back into these stocks and not spend too much time in the red or as bad of a time in the red. But a hedge should not be the majority of your portfolio. If you buy gold and it's the majority or a huge portion of your portfolio, this is not a hedge. It is now a huge investment in your portfolio. It is your cash. It's not really a hedge if it's making up the majority or focus of your investing focus. You want to make the hedge a small portion that becomes a profitable end to compensate for the larger losses that would otherwise be. And so another hedging strategy we could do, we could short, right? We can bet against the stock. We can loan out the stock and receive cash. And then later, when the price has gone down, we come back in and buy the stock. So now you can get more shares for the cash that you receive. I get one share of the S&P 500 or SPY at $480, and then I sell or I short the SPY at $480, and then it goes down to $350, and now I can buy 1.3 shares of the SPY. So I can increase my total holdings. And you can see that on the trend, again, we tend to revisit prices. So if you shorted at the top here, right, you could have re-entered only with a slight downside, and then just kept doing that every time that you got to this overvalued trend. Now, note that sometimes you can get way up here on the overvalued trend line. And this trend line is just based off of the price trend on logarithmic scale. But you can get way overvalued, and then look at the entry point. If you had gone from just the entry point here and shorted and just held that short, you'd be back at the same price. Same price. So it doesn't always work just because it hits an overvalue point. It can go much further. So we may want to just kind of be conservative with some of these hedging strategies and know the effects of the risk. With a short, you usually have a small amount of theta decay on the fact that there is an interest payment on the loan. Now, you can also use things like the Buffett indicator. You have to do some comparative analysis, but you can identify when things are overvalued. Now, they can't spend time overvalued, but how overvalued. Right now, we're historically the most overvalued we've ever been according to the Buffett indicator, but there's plenty of other indicators that you can use to try to identify. Now, shorting may be a more long-term viewpoint, but shorting has an asymmetric bet in the wrong direction. So you don't want to be net short, you just want to use it as a hedge. Now, another really simple one, but this one might be a little bit more advanced, and I have a small thing on call options and put options and just a basic explainer in my videos in my channel. But you can see that we can do a put option and trade a derivative contract. We bet against the stock with something that has leverage, but it's not like a short. Instead, I get a much higher swing in the other direction. Now, I really like these, but you do need a slightly larger portfolio balance to really make it worth your time, because these are going to get expensive very quickly. And if you're wrong, they can go to zero. Now, this is why it should be a small portion of your portfolio. But let's say I expect the S&P 500 in the worst case scenario to go down 30%. Like I'm expecting a stock market correction crash, liquidity crisis, right? Like March 2020. I think it's going to go down. Look at how Robinhood gives me this super easy way to do this, easy button. I think it's going down. I press the down button. It tells me that I can do buying a put. That's it. Just purchase a put. But I'm going to do it for a long-term time frame so that I have more time, and I'm going to do it in the money, meaning that I'm going to do it below current prices, or with a put, I want to do it just at or around current prices with a long-term, a 1 year plus time horizon. The reason why is because I want to be able to hold this for a period of time, and I don't want it to just burn cash holding it. But let's say I make it 5% of my portfolio, and I think the stock market's going to go down 30%, right? 5% of my portfolio into this, and it goes down about 30%. We go from around 380 down to 270 or so. Look, a 200% gain in this short period of time is possible. So if I do these puts, if I take these puts where it's going to be a small portion of my portfolio, and the stock that I hold, which is the other 95% of my account, goes down 30%, this is going to go up 200%, and that's going to compensate for most of it, and it'll only look like a 10-15% downside. And then I can roll that profit back into the S&P on a dip, and now I have gained shares total of the S&P. If I'm wrong, I set a stop limit, and I just say, look, it's just going to go back up, or I identify when I'm no longer concerned about the risk and I reduce it. But I can hold this for a long time, because at the most, as long as it stays in the same price range, I'm only going to burn 47%. Now, that might sound really high, but that's 2.5% of your total portfolio. If I hold it for too long and the price keeps going, it can lose 100%. You can see here in January 2023, I will lose 100% of that 5%. But that's only if I hold it through that. And since I'm more concerned about the risk at the time, then I'm probably just going to wait until I see the clarity that it's probably going to go up from there. So you can take these leveraged options. You may want to look more into how you do options trading, and you would probably want a larger portfolio balance. If you have less than 50K total invested into your stocks, then this may just be a little too advanced. This would be more like a play, like I'm betting it's going down rather than I'm hedging against my bet that it's going up long term. So you can use this. It's a trading opportunity to maximize your total profitability and to reduce your risk to the downside. I would again look more at cash. I would look more at diversification. I would look more at other monetary assets. So pretty simple short video. Thanks for watching. If you have any questions, leave comments below.